Like I'm going faster. Exactly.
Like 3 times back to back, 50%, 56%, 52%. And I was like, such a break.
Okay, we're ready to get started?
So if I get this test back,
We're right there on the 21st, which says we're finishing chapter 13 today. And then we have classes next week, even though it says there's no class, right?
wait, what?
No, that's a mistake? Okay. And then when you come back on the 5th, Monday, you're handing in your homework. There is a homework assignment. I'll post it tonight, but it's not due until the Monday you come back. And then we'll be starting chapter 12, stocks. Let's see. We were just talking about this before class started. This is the national debt. So right there, we're at 20 trillion. Looks like it's going up about 10,000 every second. Does that sound right? You stared at it long enough? All right. And let's talk about this. We have a new first place. What happened? She's in the other section, so she's not here. But let's try to figure out this. Don't forget, this is as of yesterday. The market just closed today, but this is as of yesterday. So, is this it? Right here? Oh. The history. Here we go. Let me if I change the size, you'll be able to see it better. Okay. Do you see which stock took her to first place? You don't see it?
Target.
Nope, not Target. Target's up about 1.59%. What's it called? Dine Equity. Dine Equity is up 13.5% since she bought it. $629. And it all happened, I went ahead and pulled this up. It all happened right here. Remember we saw this? I said this is the cliff going up. Sometimes you see it coming down. That would be the worst scenario. Sometimes you see it going up. Well, you know, she's in the other section, so I don't have a chance to ask her what made her decide to buy this. But she bought it way back here, January. Let's get the date on that. Whoop. Way back in January 11th. So I don't think, you know, she had any idea that this was going to happen, go up $600 and some, because it all happened just yesterday. Look at the chart here. I can't get it to come up here. Hang on a minute. Here we go. No, still won't come up. But it will all, because of this. There we go. Right there. It was yesterday. Had this big jump. And from what I can read, this company, which happens to be, this is what you should do sometimes. Open up the webpage of the company itself, if I can find it. Right there. D-I-N-E. Dine Brands. One of the largest full-service dining companies in the world. Anybody figured out who they really are, though? Here's who they really are. That's right. And they reported higher than expected earnings just yesterday or over the weekend, and so that made the stock price go up. Analysts are always predicting how much companies are going to be reporting every 3 months as to what their profits will be, you know, and how things are going along, and they beat what all the analysts thought was going to be reported, and it caused the price to jump up. That's from what I'm reading. Applebee's and IHOP. So people are going out to eat. Possibly. That's where everybody's wasting their money. Food. Not food necessarily, full service food. Right? I don't know. Now, on the other end of the scope here, hang on a minute, I gotta find it. Here we go. I want to mention, right, where'd it go? By the way, if she were here, let's go back to that for a second. If she were here, what would you recommend she do with Dime equity? 51.53 is where she bought it, 67.28. It happened yesterday, but today she stayed in and made another $153 today. And you guys think sell half? And I have to agree, because anything that goes up 30.5% in 1 month, maybe it's been a month and a couple weeks, it's just, that's hitting the lottery. And you can't just sit there and go, okay, now take it back, because it's going to be taken back if she just sits there with it. So it could still go up, and a lot of people go, oh, I feel like it's going to go higher, and they just let the money stay there. I've met many people who say, oh, I had made this much money. I met someone who said, I had $500,000 I made on Smith & Wesson, and I thought it was going to keep going up, and they lost almost all of it. Smith & Wesson had gone from $28 a share to $10 a share in a fairly short period of time. This was a few years ago, and it just happened again. Smith & Wesson changed their name to American Outdoors, if anybody looks that up, and their stock, again, just recently hit their high of like $27, $28 a share, and it slid back down just in the last month or two, maybe, or three, back down to less than $10 a share. And actually, as awful as gun violence is in our country, it almost always causes gun manufacturing stock prices to go up. And the reason behind it, supposedly, according to news, is that gun owners feel that regulations will be coming because of gun violence, and they run out and buy their guns before they're thinking they want to grab them before the regulations happen. And it causes the stock prices to go up on gun manufacturers. And then they head back down because, when regulation does happen, we hope it does, it will cause then the price of that stock to go down. So if you happen to be in any of the gun manufacturing companies, you probably want to sell fairly soon, because usually, historically, it hits up in the first week after it happens, and then heads back down even farther than where it was before it went up. So that's what did it. Now, I wanted to say, I'm trying to point out another one here, if I can find it. And is it Tessa? Where are you at, Tessa? Over here somewhere. Okay, did you know you went from 46th to 24th yesterday?
I just looked right now.
Can you believe it? That's over a 20-position jump in one day. And I tried to figure out why. And so I went to your history here. No, is this your, yeah, this is your history. And you just made these purchases recently. Tesla, Netflix, like, what we're talking about. Were you here last lecture? You weren't. We talked a lot about Tesla. You just happened to have bought it yesterday, and we had just talked about it in the lecture 2 days ago.
That's not mine.
This isn't yours? Oh, hang on then. Whose is this? Oh, this is another one I want to talk about. Hang on. Sorry. Here we go. Here's yours. Whoops. That's not your history. Here's your history. Is this yours?
Nope.
Oh, no, this isn't yours either. This is yours right here, but it's not your history. This is your portfolio. Amazon and Shutterfly. And if I recall, you bought these in January and just held on to them, right? Do you remember the date in January? Was it the 31st?
Late. Yeah.
Late? Okay,
Yeah.
the last day. I'm getting my transaction in for January.
I think it was like the 28th.
Which, by the way, if you have not done a transaction for February yet, don't leave it to the last minute, because we're not even I'm not even going to be here next week to remind you. And if you don't, and when you come back, it will be March. So if you haven't done a transaction, please do it tomorrow. I wouldn't go any later. So anyway, she got these two stocks and then was losing money on them, I believe. And then something happened yesterday that one of these, I don't know which one yet, I haven't looked into it, came back, and you made money on both of them today. But as you can see, you were still losing money on Amazon until today, and you're up pretty good on Shutterfly now. So do you remember which one? Matter of fact, Shutterfly is up 13%. So this could be the one that maybe made the comeback. I'm not sure. Do you know? I'd have to look at where they were in the last several weeks. But
No, I'm one of them just.
do you remember? Really? Do you remember why you bought Amazon or why you bought Shutterfly? Though, was it just the first ones you found type thing?
Yeah, I do. I just was like, oh, I do a lot of shopping on Amazon, and a lot of people do, and Shutterfly
So you said because of that, so you had to search them out though, or
No.
oh.
I just-
How did you, but when you made the trade, you had to at least know what their symbol was to find them.
Yeah, I had to look at, yeah, I looked that part.
So you did look it up. It's not like the symbol jumped down and go, oh, look, that's Amazon. You put an A in, I'll go with Amazon, that kind of thing, or?
No.
You did, okay. So you were going with something that you heard of, something that you use, and you went with that because it would be more comfortable. And it's paid off. This should give you hope. Everybody should have hope. I mean, look at, we only have about a month and a half left of the game, and you jumped up 20 spots, and I noticed that yesterday a lot of people made a little jump from different spots, such as, let's see, we got 51, Jay Bruman? He's not here?
No, he's here.
Oh, the other class went from 51 to 27. What a jump. And 47 to 28, 43 to 29, 49 to 30. When I see that many people make a jump up, that means there's that many people who made a jump down. So I said, I'm going to go to the very end and see if finally, if Zach is no longer in last place, and sure enough, he's not in last place anymore. Alec said, I want to take over last place.
Yeah.
You said, how can I lose enough money to get in last place? Right?
Yeah.
So I went ahead and checked your...
Yeah. So what I did in the beginning was I bought Movie Pass, and I.
Is that what that is?
Yeah.
That's a movie pass?
Yeah, it's a Movie Pass.
I didn't know what that was.
Yeah, and so.
And a lot of it.
Yeah, I said all or nothing.
Here's what he spent to buy it. Here's what he got back when he said, I got to get out of this. Now at this point, I'm surprised you sold, only because, you know, it's like, well, how can I lose any more money? It's got to come back a little bit. But you said, no, I'm bailing.
I dropped so much cash after that, so I was like, you know, I'm done. I'm not gonna ride it anymore. I wasn't risking it.
And then you went ahead and went into ones that we're familiar with. Tesla, when did you get Tesla? What's the deal with you guys with Tesla yesterday? Is this an unbelievable coincidence, or is it? Oh, I was looking at this thinking it was your portfolio. Is that what it was, Tesla? She's not even listening. I thought this was your portfolio. Is that why? Okay, you don't have Tesla. All right, that's what it was. So, what made you decide to get into Tesla yesterday?
I didn't think I bought Tesla yesterday. I thought it was 2 days ago, but.
You may have tried 2 days ago and it finally went through yesterday, possibly.
No, I looked at it and I saw that it was kind of going on the outside. I just tried to get into it. I was in last place, so I said, you know what, I'm just going to try and ride something out.
Hey, could you look and tell me what's that doing today now? That it's 8 days after you sold it.
Yeah.
I want to know if you regret selling it, if it made it come back, or what, or is it even lower and it ended up being a great decision? In most cases, when something drops this much over a fairly short period of time, I hang out for the rebound because some of it has to come back because this is unbelievable drop.
Actually, it's dropped to 450.
450?
Yeah.
Wow. Buy it. Unless there's something you know. Is there something going on with movie passes? Is that what this is, right?
No, actually, my uncle is pretty big into stocks and stuff. He told me if you do in the class, he's like, get into it where you know.
He told you to buy it.
Yeah.
Did you tell him what it did for you?
I'm about to show him.
Man, tell him thank you for nothing. Matter of fact, whatever he says to buy, you know, you probably don't want to buy it. But wait a couple weeks, then buy it, because he's, you know, possibly picking losers. So, yes.
So, purchasing, if you have a lot of people purchasing one particular stock, does it make it go up?
It does. Supply and demand. In the real world, in our game, it won't. But in the real world, if all of a sudden a bunch of people are buying the stock, that does cause the price to go up. That is one of the items. You know, and usually it's when some really good news comes out for that company. Everybody who's seen that news is trying to react on it before everybody else. So they're buying and buying and buying, and then the stock price goes up, and then all of a sudden you'll see those who are kind of day traders where they're just trying to grab something that would go up. They're hoping everyone else will see that news after them, and they'll buy. Then they wait for that to happen, and then they sell. And then you see the price go back down, and then it eventually settles to where it would have been. But that up and down is people trying to buy because they saw something in the news. And then when you see a stock price go up, and then the news comes out, and then it goes up even more, that first up were inside traders. who knew about the news before it was public. And that's a very common thing, even though it's against the law. But it's so hard to catch. You know, unless someone does it with a lot of money, and then they can catch it. So anyway, congratulations. He's staring at the screen. Congratulations.
Oh, thanks.
You got a plan together to get out, and don't forget, well, you got your transactions for February. Okay, so you need to worry about that. You know, it's all a matter of hitting that one that has that big upslide, like, where to go? Like this. Just finding that one right there is all you got to do. Is you just got to try to say, it's like throwing a dart almost. And then just hang in there until it happens, hopefully. I did look at their financials. This is, again, this is IHOP and Applebee's, right? Is that what they are? But look at how old they are, as of December 2016. But it's nice to look to see if they're making money. And so, don't forget now, these numbers you're looking at are in thousands. So their revenues are $633,973,000 in revenues. And then they have their cost of revenue. What would cost of revenue be? Probably all the food. All the food related to what drives those revenues is that spot right there. And then you have all your operating expenses. Everybody's paid. Their hourly wages, salaries, all the employees right there. And other things. You know, rent on buildings or mortgages or interest paid. There's interest expense. They obviously have some loans. Maybe they own a lot of their own buildings. $61,479,000 in interest on loans that they have. That's a lot of money. So you get to the bottom here, and then you go, net income, $97 million. So they're making money. $97 million isn't bad, that's for sure. And you look at that and you go, well, at least they're healthy. And you can look at their balance sheet. You can look at their cash flow. And I notice on their balance sheet they have a little problem going where they have kind of a negative net worth in a way. But I haven't quite figured it out completely. So anyway, that's Investopedia. Everybody still have hope. Don't forget to get a transaction in for February because we won't see each other again for the month. This is the last time I can remind you. Now, mutual funds. We're back here. I want to start with, what does family of funds mean? So I'm going to go to, let's see, slide 17. I get this to work. And the definition you see here says, family of funds exist when one investment company manages a group of mutual funds. Now, I want to make sure you realize what that means. The one I've been showing you in class, is my favorite, is the Fidelity no-load mutual fund company. And I went ahead and said, show me all the mutual funds that a customer, an individual could buy through Fidelity. Look how many there are. 10,921 mutual funds. But then I realized Fidelity has this situation where they have investors who may want to get into mutual funds outside of Fidelity. And so that's why there's so many. So you can narrow your list down by, first of all, I always click on no transaction fee fund. Meaning, no loads. Nothing to get in, nothing to get out. Watch what happens to the number when I click that. Now we're down to 3,694 of them that don't have fees. These are the true no loads. Then I said, if I click on this box, Fidelity funds only, that's what family of funds mean. It means all of them that are within the family of Fidelity, in which the employees who are managing them work for Fidelity, and their names all have Fidelity in them. And now I'll click on that, and we take the list down to 326 no-load, no-fee mutual funds are part of Fidelity. Now there's an advantage to staying within the family. If you, even though you could have a Fidelity account and you can go ahead and buy mutual funds from other companies, but the advantage to only buying Fidelity's mutual funds, staying within the family, is when you go to transfer money in and out of mutual fund, it is so much faster and easier, and you don't have to worry about, oh, was there a fee because it was a different company type of thing. So I'm a big believer that if you set up an account at a no-load mutual fund company like T. Rowe Price or Vanguard or Fidelity that invest in their family of funds that are managed within, and it makes life a lot easier. Because if you go and do a transfer from outside of Fidelity with your Fidelity account, there may be a limit on how many you can do and not get charged a fee, and all those different rules that exist, and you'd have to read all that. But when you stay within the family, usually the limits are waived as to how many. You can go in and out several times. I mean, there's a limit, once per month maybe, or something like that, or 10 per year. But if you're going outside the family, sometimes the most you can do is 4 per year to avoid fees, because they're not even part of Fidelity, and they're just doing it for you. Fidelity has it all set up where if you have an account with them, you can even buy and sell individual shares of stocks of companies right there in Fidelity, even though they're a no-load mutual fund. And what's crazy is their fees are almost better than any discount brokerage out there. $4.95 to buy, $4.95 to sell. I mean, that's cheaper than our game. What are we, $7.99 or $6.99? $6.99, $7 in, $7 out. So, you know, you see what a good deal. So I clicked on family of funds, which are Fidelity family. No transactions, got it down to 326 of them. If I start scrolling down, look at the names. They all start with Fidelity, because they're all in the family of funds. All right? Look at what some of these did. 52.54% in the last 12 months. That's unbelievable. Now, how do you make money off mutual funds? These are the 3 ways to make money, and a lot of students get these second one and third one confused with each other, so I want to make these clear. Dividends, capital gain distributions, and capital gains. Very different from capital gain distributions. Dividends, capital gain distributions, and capital gains are the 3 ways to make money off of mutual funds. So, if you're in a mutual fund through Fidelity, and the Fidelity Mutual Fund owns shares in, let's say, 50 different companies, and a few of those companies pay dividends, when it's time to pay dividends, they'll pay them to the mutual fund. The mutual fund then will take those dividends and start sending checks out to everybody who owns shares in the mutual fund. And all of a sudden you'll get a check in the mail, and maybe only for like $7. You go, what's this? And it will say dividend distribution. It distributed the dividends it received back out to the shareholders who own shares of the mutual fund. So that's how you can make some money, the dividend. Next, capital gain distribution. This is where the mutual fund manager, again, 50, 100 companies of shares, right, is almost every day buying and selling different shares. Well, if they bought it at one price, sold it at another price that's higher, that's a capital gain for the mutual fund. And part of that capital gain gets distributed to the people who own shares in the mutual fund. And then all of a sudden you'll get another check in the mail, and it will say capital gain distribution. And usually that check's a little bigger. Maybe it's $20, $30, $40, depending on how many shares you own, of course. So there's a second way to make money. But most of the money that's made on mutual funds is when you originally got into the shares of the mutual fund, and then you said, now I'm going to sell my shares in the mutual fund, and you're selling them for a higher price than you bought the mutual fund to get in. So for example, I'm just picking one at random, Select Software and Internet Technology Fund. Well, that's pretty in only one area. 2,500 minimum to get in. Net asset value, we talked about last lecture, how that's the price at the end of the day. It's at the market's close, that's probably yesterday's price. Oh no, yeah, yesterday's price. So tomorrow you'll see this, it will say 221, it'll have a new, it's the net worth of the mutual fund divided by the number of shares. And so you bought in, let's say 2 years ago at $100. And maybe you bought 50 shares. There are 10 shares, not even that, 5 shares. It's only 2,500 to get in. So 2,500 divided by 177, however many shares that is. You bought it 3 years ago at $100 a share. And now you're ready to sell. You've gained $77.35 for every share you owned all that time. And when you sell it, say, hey, I'm handing these back in now, I'm ready to sell it. All you got to do is get online, you can sell it, you just transfer the money out, or you can call them and they'll send you a check, or they'll transfer it for you, and they charge you nothing. If you want it wired right away to your bank account, there may be a small $5 fee or something, but if you take a check or just have it put into your money market fund, like the savings account of the Fidelities, it costs you nothing. And that's called a capital gain. That's where most of the money's made in mutual funds. Is buying it for one price, hanging on to it for a while, selling it for a higher price. So dividends, capital gain distributions, but capital gains is where you bought it at a lower price and sold it at a higher price. Let me review capital gain distribution again. You're part of the mutual fund, and the person managing, the team managing the mutual fund, is buying and selling individual stocks, and they're making money off the buying and selling of individual stocks called capital gains. Then they send checks out to the shareholders for part of that money they made to do what's called a capital gain distribution. Very different than you didn't have to buy or sell anything. You just got the check because you happened to be owning shares at the time in which the capital gain distribution was taking place. Yes?
Okay, so these money managers.
Yes.
They are actually making money off your money.
Kind of. They're making money for you off your money.
Are they making money for you?
For you.
They're not making any.
They're making money, they get paid a small salary, and then this, if they perform exceptionally well, they get this unbelievable bonus, usually at the end of, near the end of December. And that's really how they make their money. They're bonus driven, because it's all about that bonus in the financial world. You know, they may, if they live in New York, and maybe, like I told you, my one friend was making $150,000 a year. Living in New York, that's like only making, $60,000 a year. And then, but when December came, and he outperformed the market, he'd get over $1 million in one transaction as a bonus.
Okay, can we take an example like Amazon, for example? Amazon, so like if
Amazon's not a mutual fund though, that's an individual stock. So if you're in this mutual fund, and the mutual fund happens to own some shares of Amazon,
right.
and the mutual fund manager sold those shares of Amazon for a higher price than what was bought, that's a capital gain for the mutual fund. Then they'll send checks out to shareholders. That's a capital gain distribution from the capital gain made by the manager.
Okay.
Your capital gain is when you decide to leave the mutual fund and you said, I'm out of there at a higher price, net asset value, than when you got in. That's the capital gain. That's where you make most of your money, right there. Now, there's a great example, by the way, on page 444 that I want to highlight, because what you're about to learn, this formula, calculating how much profit you made off a mutual fund investment, is probably the most important calculation from this chapter. And it is for sure on your next quiz and possibly your final, because out of this whole class, as far as investments concerned, most of you probably may only experience mutual funds in your whole life because you just may not be into investing. But you are forced to be into it because of your retirement program at the company you're going to be at eventually. And so you want to know how much money you made off the investment. And that's where this calculation comes in. You have to add up the dividends that were distributed to you while you owned the mutual fund. You have to add up the capital gain distributions, the checks that were sent to you. And then you got to figure out how much you made from how much you spent when you bought it, and how much you got when you sold it, and that difference is the big gain called the capital gain. You got to add that up. And there's all the money you made off it, those three things. In this case, let's see, what do we got here? I'm going to the second paragraph. For example, assume you had 100 shares of Majestic Growth Mutual Fund at $12.20 per share. And so 100 shares at $12.20, you spent $1,220 to get into that mutual fund. And how much time went by? 12 months later, it's just a coincidence, it's exactly a year, kind of makes the math easy, but exactly a year later, you received income dividends of 20 cents a share, capital gain distributions of 30 cents a share. So there's the money we brought in, 20 cents times 100 shares. What's the other one? 30 cents times 100 shares, there's the second one. And then let's assume you sold it at the end of these 12 months for $13.40. There's the big gain. $13.40 is what you sold it at. You bought it at $12.20. So is that $1.20 times 100 shares was the big money you made. So you made the dividends that got sent to you. You made that capital gain check that got sent to you. And now you sold your shares, and this is where you made the big money, and you got to add them all up. 100 shares times 20 cents. There's $20 for those dividend checks you received. 30 cents times 100 shares, here's your capital gain distribution checks you got, $30 worth for the year. and then you sold it for $1.20 more than you bought it for, that's $120. The 120 plus the 30 plus the 20 is $170 is the profit you made off this investment on this mutual fund. You got to take it a step farther. You got to divide the $170 by the initial amount of money you had to put up to get into this investment to figure out what your percent gain was. So 170 divided by 1,220, remember we bought in at $12.20 a share, 100 shares, so 1,220 is 0.139. You made 13.9% gain on everything that had to do with this investment. Your dividends, the checks you got, capital gain distribution checks you got, and the money you made by getting out of this mutual fund for a higher price than what you got in for. All of that added together was, now here's reality. You may have held this mutual fund for 2 years, not just 1 year. And you are being asked, what was your annual percent gain? Does everybody hear this? This is a big deal. This calculation, we're hypothetically pretending you had it for 2 years instead of 1 year. And the last part of the calculation is because you're going to be asked, what was your annual percent gain for 1 year? But you were in it for 2 years. So you would take that percent you calculated, 0.139, and divide it by the number of years you had it. So really, if this were a 2-year investment, it would be half of that. What is it, about just shy of 7% a year is what you average, with the dividend, the capital gain distributions, and the fact that you sold it for more than what you bought it for. So that's the last step I want to make sure you understand. You figure out all the profit, divide the profit by the amount of money it took for you to get into the investment, and then take that percentage divided by however many years you were in it. So let's say you were in it, I want to make sure you get this. Let's say you were in this 30 months. What are you dividing the last calculation? You got a percentage, but you were in it for 30 months, and the question says, what was your annual rate of return, meaning yearly?
2.5.
Because it's 2.5 years. 30 months is 2.5 years. You divide by 2.5 to get that per year. All right, so the last step is dividing by however many years. You got to convert 30 months into how many years is that? 2.5 years. 36 months, 3 years. All right, that's probably the most important part of today's lecture. So let's just go home and start vacation.
Yeah, it's good.
Yeah. When you walk out, I'll just finish the rest of the camera, and you can watch it later while you're on vacation. I was going to say somewhere on vacation, like Florida. Who knows where people go anymore? I don't know. When I was your age, I was in Florida driving my car on the beach in Daytona. And my friend and I were so out of money that we couldn't stay in a hotel, and we had to sleep in the car on the beach on the last night because we were out of money. We drank all that money. All right? Now, bond mutual funds. Whoops. Where am I at here? Back to this. I want to learn about some of the names of bond mutual funds. Well, Fidelity must have some bond mutual funds. But right now we're looking at a list of 326. How can I break it down just to see the bonds? Fidelity's website is so perfect. You can literally just go down here and click on, I want to see municipal bond mutual funds, and I want to see taxable. Thank you. I want to see taxable mutual funds. So I clicked on municipal bonds and taxable bonds. So these will be the bonds. I still have no fees collected or checked, and I have Fidelity still checked. So this is within the family. Bonds that are municipal and corporate bonds. 68 of them. So you'd have 68 of them. By the way, there'll be at least 2 of these in the possible selection of mutual funds when you go to that company who says, okay, we have a retirement program, you have to select where you want your retirement to go to. There's going to be maybe 10 or 12 choices. At least 2 of those are going to be bonds just like you see here. Every company includes bond mutual funds, stock mutual funds, a mixture, a blend of each, and then they have that safe one, like a money market fund, where maybe it's only making 1% a year, but you never lose money. If you think the stock market's going to crash, take your retirement and put it in that safe zone, and wait for it to crash and then move it back into the mutual fund. But anyway, here are the bond ones. These are all bonds. Remember when we talked about bonds and that previously, and we had to calculate to tell the difference between a municipal bond and a taxable corporate bond because one was not taxable? If a municipal bond mutual fund exists, all that's in it are municipal bonds, so it is non-taxable. You don't even have to be in the municipal bond to avoid the tax. You can be in a mutual fund that's in a whole bunch of municipal bonds, and you get to pay no taxes on it. So for example, I'm looking for one with the word municipal in it. Here's a tax-free bond fund. Muni. Muni means municipal. National, long-term bonds. How has it done the last 12 months? See, it hasn't done that great. Interest rates have been kind of going slightly up in the last 12 months, and bonds just don't. Look at how this bond mutual fund has done since January, just the month of January, because all of these numbers are based as of January 31st. They won't update until the next month ends. Losing money. A lot of bond funds lose money because when interest rates go up, when they're heading up, bond mutual funds in your retirement are what you want to be out of. And if we have some kind of financial crash and you go, wow, I bet they're going to stimulate the economy by lowering interest rates. If you feel the interest rates are going to be lower, you start seeing on the news, they may start lowering interest rates. You want to get to your retirement and start shifting your money into the bond mutual funds. Because if we could go back to 2009 and 2010 and 2011, these bond mutual funds on this list were probably outperforming every other mutual fund because interest rates were going down. So here are some of the names of them. And what's nice about these tabs up here is I always like to see how risky is this mutual fund. And you click on risk, takes everything on your list, the same 68 funds, and brings you a risk chart. This one is probably the lowest risk right here between what we can see on the screen here. And that's that municipal national long-term bond fund right here. This is an intermediate term bond, but this is not tax-free. We're going to see there's another municipal up here. These are all, when you see the name high yield, right up there, see high yield bond, high income fund, global high income fund, right there, high yield bond. That goes back. Again, where's our Moody's? Wait, you don't do that. It's on our PowerPoint. Where is this? Slide 14. Right there. Where is it? Right. There it is. The word high yield in the name of the bond or in the description of the bond means it's a junk bond mutual fund. It is investing in those risky type bonds, trying to grab that higher rate of return, but it is taking a lot more risk. So they disguise the word junk bonds with the word high yield. So those up there that say high yield bond, the money managers are investing in junk bonds, which would be, I believe, if we look back at that Moody, it was BA or BAA and below. I think, wasn't the rating something like BA and below or something? All right, so real quick, here's some other names. Intermediate corporate bond. That means most of the bonds are going to mature between 5 and 10 years, and these are corporate bonds, so they're taxable. Intermediate U.S. bonds. This mutual fund's investing in treasury bonds, United States bonds that are going to mature in 5 to 10 years, those notes. Long-term corporate bond. These would be like those 30-year and 20-year maturity corporate bonds that this mutual fund manager is buying for this mutual fund. Long-term U.S. bonds, that would be those 20 and 30-year U.S. Treasury bonds. There's municipal bonds. We just talked about those. They're tax-free. Short-term corporate bonds, short-term U.S. bonds. And those are it. Those are the names you would need to know, let's say, for a quiz, for example. High-yield bonds, intermediate corporate bonds. And now you know about bond mutual funds. Index funds. We're going to slide 11 for a second. Right here's a little description of it. This is kind of a different type of mutual fund. It's a mutual fund, just like all the other mutual funds. But the difference is is that usually there's only not a team of managers, but just one manager. And usually this manager who's managing this index fund is managing some other funds because this is the easiest type of mutual fund to manage. How these index funds work is usually in the name, they'll put whatever it is they're mirroring. They are going to have the stocks or bonds inside of it that are inside of whatever it is that they're mirroring, that they're trying to duplicate. So if you have one that says Dow Index Fund, it's saying what companies make up the Dow Index number, and there's like only like 30 or 40 companies, and they'll say, and what percent of each company is making up that Dow Index number, and then it mirrors it and says, I'm going to buy this many shares, this many shares, this many shares of those same exact companies so that the mix is the same percentages, and then the manager just watches the Dow Index, and if that changes, and Dow Index sometimes says, we're no longer going to have blankety blank company part of the Dow, and we're bringing in this company. When that announcement happens, the manager of the mirrored index fund says, I'm selling these shares, I'm buying these shares, because it mirrors the index. And if you saw a graph, if the Dow goes up, this mutual fund goes up exactly like it. It just is right on top of it on a graph because it's mirroring it. S&P 500 index funds are mirroring the S&P 500. It will have shares of all 500 companies that are making up the S&P 500. The Russell, whatever, 300, it will mirror that. All these index funds are just mirroring something. So if we go to Fidelity and go, wow, what about an index fund? I want to show you the advantage of an index fund. So I got to go down here to classification. You got to remember how to find index fund. No, I can't remember. Anybody see it? Ooh, there's money market funds out here. Can we get rid of the bond funds? I do not see an index fund choice there as to a type. But you could just click on it and bring up index funds. Maybe you have to bring them all up. Real quick, I want to show you these money market funds since we're going to skip index funds. So usually you see the name of whatever it mirrors in. These money market funds that you're looking at right now, how many are on there? 86 of them within Fidelity. These are like the savings account I was talking about. This is your safe haven. They have names like, what is this? Fidelity funds only, no fees, money market. I still got taxable bond down there, that's why. I can see some names that shouldn't be there. There we go, let me unclick that. Now let's see how many. 40 of them. And they're all money market. Prime money market, money market, money market tax, money market. And they usually have the name money market within their name somewhat. Money market, money market. That's the name of their savings account. It would be the equivalent of. Very safe. Doesn't make a lot of money. Let's get the performance overview here. In the last 12 months, look at what they've been doing. A little less than 1%, 1.06%, 1.12%. Now, some of these are like for full retirement programs, so it takes like $1 million to get into them. So I'm going to go down here, and I'm going to go, where is the expenses, returns, there's somewhere you can click on it to say, hey, what if I only want to invest, want to get into one that I can invest in? Let's see. Whoops. Income characteristics. Here we go. Average duration, average maturity, last dividend. No. Somewhere on here you can go ahead and put how much. There we go. Minimum investment. I'm going to move that down to something more realistic. Let's say it only takes $5,000. No, let's go down to $2,500 to get in. Look at the list now. There's 6 of them. If all you want is one that takes as little as $2,500 to get in, to open your account, this would be where you start. Send them to, when you got $2,500, you send it here, and you say, I'm putting in one of these funds. and then you just start doing research, and when you're ready to switch over to one of the other mutual funds to make some real money, your money's right there. You have an account set up now. You just go click, click. And because it's mutual funds, you got to wait till the end of the day, and whatever the price, net asset value of that mutual fund you're going into at the end of the day, it transfers over, and all of a sudden you'll see now how many shares you have of that mutual fund. And when you go, oh my gosh, I want to get out of this mutual fund, click, click. You're going back into one of these 6 money market funds then, where it's safe, where there's no way to lose money. And you're only making 0.5% a year, 0.62, 0.93, almost 1% in the last 12 months. But you're never losing money. That's what these are about. They're like a savings account. They're the safest thing that a no-load mutual fund company can offer customers. They're not insured. At the bank, when you put your money in the savings account, it's insured by the U.S. government. If that bank all of a sudden, goes out of business, you're going to get your money back. The U.S. government's going to make sure of it, and they're going to send you a check and the interest that accumulated at that point. These are not insured. I mean, don't get me wrong. Fidelity manages trillions of dollars, not just billions. They're probably into the trillion. And so it's fairly a safe company. I mean, the whole economy would have to collapse for you to lose your money, for Fidelity to go out of business. And it's possible. But it's just, if that happens, the odds of the government having the money to pay you back in the savings account, so it's almost the same thing. So, how do we feel? We understand? I just wish I could have found that little box for index funds so you could see some of the names of them. They're the names like a Dow of an index, of S&P 500 or Russell. And what they have are very low expense ratios. So do, by the way, so do money market funds. Look at the expense ratio. Do you remember what our target was? What do we compare the expense ratio to? What was the percent of expense ratio we compare these to? I said I never would get into a mutual fund that had an expense ratio above what? 1%. And the ones we were looking at were 0.79, 0.78 of almost 3/4 of 1%. These are not even 1/2 of 1%, because these money market funds are hardly take anything to manage, and this is what you would see with index funds. They're also less than 0.5% because there's hardly any managing that has to take place. If the index is making a change, the manager makes the exact same change. They don't have to sit there and watch prices of stocks all day long. And that's why the expense ratio is so low on index funds and money market funds. Most of the money is going to the investors. All right, how are we doing? Exchange traded funds, they're different. We're going to slide 5 on the PowerPoint. This is different. So they're kind of like index funds in a way, but what's different about these is you just can't get a hold of Fidelity and go click, click, I want in this index fund or in this exchange traded fund. With an index fund, you just go click, click, you're in the index fund, a bond fund, a stock fund. Electronically traded funds are very different. They're kind of like stocks. The prices are changing on these every second. And you get the price just like a stock anytime during the day. You don't have to wait for net asset value. That there's only so many of these shares out there, and somebody has to be selling the share, and then a buyer, and they connect, and that's the price, right then and there. So that's the difference between these mutual funds and all the others, is that they're kind of like stock, and that the price is going up and down all the time, and you can get it right then. You don't have to wait till the end of the day. Closed-end funds, this is where a mutual fund manager says, hey, when this mutual fund reaches $10 million, it's closed to new investors. And when that happens, the only way you can get into that mutual fund is when somebody who's in it already is selling their shares. And that's how a closed-end mutual fund works. And sometimes those perform better than others only because they're so hard to get into, because you're waiting for somebody else to want to get out for you to get in. So it's not necessarily always based on just net asset value on that one either. But all the other ones are net asset value, the net worth of the mutual fund divided by the number of shares. Closed-end funds, exchange-traded funds are what we just talked about. And last, I'm going to slide 26. Taxes. Taxes. You got this dividend check in the mail from the mutual fund you're in. You got this capital gain distribution check in the mail. And you may have sold some shares in mutual fund. All of this money, if it's not a municipal mutual fund, are taxable. All of it. Dividend check, the capital gain distribution check, and the fact that you made money by buying it at a lower price and selling it at a higher. All taxable. But there's two types of taxes. You can either be taxed what's called a short-term capital gain tax or a long-term capital gain tax. The long-term tax is much lower than the short-term tax. And here's the difference. If you're somebody who gets into a mutual fund, and maybe you got a dividend check, and maybe you got a capital gain distribution check, and then you sold to get back out of that mutual fund, and the time you bought and sold was less than 1 year. Let me say that again, was less than 1 year. You have to pay full taxes on that money, just like it's income, whatever tax bracket you're in with your income. Full taxes. But if you held on to the investment, the part that's capital gain from buying and selling it, the biggest part of the money you make off it, longer than a year, you get a discount tax. Significant discount tax. Usually about 10 to 15% less in taxes you have to pay than you do on your income. You get a discount because you held on to it for longer than a year. Long-term and capital gain tax calculations are all based on a year. You know how you get a W-2 in the mail, right? When you, at the end, January or February of the next year, because the year's over and you've been working at a job, you get something just like a W-2 from the mutual fund company, and you'll get one that whether you sold your mutual fund or not, because you probably got some dividend checks and some capital gain distribution checks, and those are taxable. But the part where you bought into the mutual fund and sold it, that will also be on that W-2 looking thing. It's called a 1099, but it looks like a W-2. And that part on there will have a word next to it that says either short-term or long-term. If the word short-term's on there, you have to put it on the tax form where it says short-term investments, and you're paying full tax on it. If the word long-term's next to it, it means you held on to it for longer than a year. You get to put it in another form. A calculation gets done that lowers the amount you have to report, which ends up allowing you to pay far less taxes on it, usually 10 to 15% less taxes on it than you would normally. And then the number at the end of that form goes back on to your 1040 form, your tax form, and you're not paying taxes on the whole thing because you got this huge discount because you held on to it for longer than a year. And if you ever get to a situation where you're going, oh, I need some money, I'm going to have to sell some of my investments, this is a big deal to say, I'm not going to sell any of the ones I haven't had for a year yet. Because to pay that extra 10 to 15% in taxes doesn't make sense to sell those compared to selling one that you've held for over a year. You want to focus on, if you have to sell an investment, you want to sell one that you've had for over a year. Only look at those to decide which one to sell. Because you're paying such a lower tax on them, there's a huge benefit. You'll come out way ahead by selling one of those instead of the ones you just bought recently because of that tax savings. So that's the big deal. You ready for the in-class? Our last in-class of February? You thought I was going to say the year? This is our in-class. I'll post the homework tonight. I won't go home until about 8. So I'll post the homework. You have all the way until March 5th to do it. I'm sure some of you won't do it until March 4th. No, 5th. That's right. I forgot. The March 5th, but it's not that hard. But you're going to forget a lot of this stuff. So,